people have different reasons to go into dividend investing. Some want to grow their capital, and dividends give them the stability they need when markets fall down. Others simply find it satisfying. However, the most common answer is passive income or retirement. A lot of people start off by looking for the highest yield. JEPI, for example, has become so popular recently precisely because it pays a high dividend of 9.7%. On top of that, it pays dividends every single month, which is a big reason why people like JEPI. However, there are some issues with this fund. I've said this before, but the biggest issue with JEPI is the fact that most of the payouts do not qualify as dividends. Why? Because they come from selling options and collecting the option premium. This means you end up paying a load of extra taxes if you don't own JEPI in a tax-efficient account. Another problem with JEPI is the unstable payout. Option premiums go up and down depending on volatility. That's just the nature of the game. However, that means JEPI pays you a fluctuating dividend. Am I saying JEPI is a bad pick because of that? No, there is a time and place for JEPI, absolutely. However, if you want a stock that pays you consistent monthly dividends with a yield of 15%, then keep watching. Right now, it looks like a good opportunity, but there is a small catch. The stock in question, AGNC. Now, AGNC is technically a mortgage rate, not a stock. There is a difference. I can already picture a lot of you saying, are you seriously comparing JEPI, a covered call option ETF, to a mortgage rate? Good question. The two of these have really different characteristics and investment cases, no question about it. Right now though, I think AGNC looks like the better investment option if you're happy to take on some risk. There's a better dividend and a good chance for price appreciation. Allow me to explain. Like I said, AGNC is a mortgage REIT. This means that AGNC raises capital, invests in mortgage-backed securities and related assets like swaps, then pays shareholders most of the profits. They do not own any real estate like normal REITs, and that's a very important distinction. AGNC focuses on agency mortgage-backed securities, or MBS. That's where the name comes from. Agency simply means that the securities are issued by government-sponsored enterprises like Fannie Mae, Freddie Mac, Ginnie Mae, or even other private lenders. The benefit here is that these agency MBS can be guaranteed, sometimes even by the government. Not always, but they usually are, especially if they come from Ginnie Mae. So, what AGNC ends up doing is they start leveraging, and they leverage a lot. By latest figures, AGNC has a leverage of 7.2, which they have been trying to reduce over the last couple of years, as we can see here. Why, you may ask? Well, as we can see here, the rising interest rates have really dented AGNC's portfolio. It went down from 87.5 billion in Q2 of 2021 to just 58 billion as of the latest quarter. Ouch. As we can see here, their book value per share dropped from 17.39 to just 10.26 in just 2 years. On the bright side, it has stabilized over the last year. Still, that's a big drop, especially considering that this is one of the most important metrics for REITs. This happened because AGNC has a portfolio of 15 and 30 years fixed-rate mortgages. As interest rates went up, these fixed-rate mortgages became less and less valuable. Currently, their assets yield a weighted average of 3.89%. Meanwhile, AGNC is borrowing at close to 5%, up from 4.5% in the previous quarter. However, despite all of this, AGNC managed to start gradually increasing their net interest spread. How, you might ask? After all, their average asset yield is only 3.89%, but they borrow at a higher percentage. How are they making money? The answer is pretty easy: hedges and swaps. Right now, AGNC has an unprofitable MBS portfolio. In the last quarter, the interest income was only $457 million compared to $526 million in interest expenses. The result was a loss of $69 million on interest. However, their gains on derivatives are close to $1 billion. That's how AGNC ended up the quarter with a profit of $378 million. Because of the swaps, AGNC has an actual cost of funds of roughly 0.63%. So, despite all the panic and the fuss, it looks like AGNC is actually doing fine on paper. They're not smashing expectations, but they're not struggling either. Personally, I think there are two ways to look at AGNC, and I have to warn you, this is very far from a safe bet. This is is the bear thesis, the pessimistic one. Historically, AGNC has done really bad, even without the high interest rates. If you had invested $10,000 in AGNC and another $10,000 in S&P 500 10 years ago, kept reinvesting the dividends, the difference would be shocking. You would have only $12,613 in your AGNC investment, whereas your S&P investment would be worth close to $39,000. And if you didn't reinvest the dividends and just use them as a side income, then you would have just $3,400 in AGNC compared to $31,600 in the S&P. AGNC also have a problematic dividend track record. Over the last 10 years, they have cut dividends 5 times and raised them not a single time. Even if we set dividends and performance aside, the interest rates pose another risk. AGNC is very susceptible to sharp rises in interest rates. If these happen again, AGNC could continue to take book value hits. Plus, AGNC's business model revolves around a normal yield curve, where short-term notes and bills have a lower interest than long-term bonds. Right now, we have an inverted yield curve, so short-term interest rates are higher than the long-term ones. If this continues for too long, AGNC's existing credit swaps will expire, and getting new ones can be a lot more expensive. Overall, there is plenty that can go wrong, and you need to ask yourself whether the 15% dividend yield is worth the risk. However, there is also the bullish thesis. AGNC has been very active in updating its portfolio. Last year, its portfolio had an average coupon of 3.89%, and this year it's up to 4.42%. The longer interest rates stay up, the more opportunities for AGNC to scoop up fixed-rate mortgages with a higher coupon. The current expectation is that interest rates will start going down in mid to late 2024. This time next year, people anticipate interest rates of about 4.5% to 5%, down from 5.5%. If this starts happening, AGNC will find it cheaper to finance itself. The result will be a lot more cash from operations. More importantly, their book value could jump up in the same way that it crashed over the last 2 years. When book price goes up, the stock price follows. Essentially, if we get a soft landing, interest rates go down, AGNC has the possibility of jumping in price, doubling in the best case scenario, and even increasing dividends. Wouldn't that be nice? I want to stay optimistic, mainly because I already have 240 shares in AGNC at an average price of $12.6. Of course, that makes me a bit biased, but I think AGNC has a good fighting chance here. Wall Street analysts are a bit mixed on AGNC, but lean towards positive. Same goes for the authors on Seeking Alpha. What do you think though? Is AGNC a good opportunity right now? Let me know in the comments, and please leave a like if you enjoyed this video. Thanks for watching, and I'll see you again soon.